Okay, what I want to do in this video is kind of give an introduction into the next section of the IB course, which is cost of production. Okay, now it's not just cost of production, but it's really part of market failure. But you cannot understand why certain firms' actions cause a market failure, which is not bringing about the most efficient allocation for society in terms of production and consumption of goods and services, unless we understand cost of production. So that's why we're starting here. Okay, now I suppose a very important thing to understand is this concept of the rational producer. Okay, so what is a firm, right? Well, a firm is an individual unit of business which produces, okay, goods and services, produces output and then sells it in a market. That's all a firm is, okay? Now you must ask, why would anybody set up a firm? Okay, well, the firm has essentially three main aims, and this is really important because this leads into cost of production and why they are so important. The first aim is to produce goods and services that consumers actually want. Okay, that's the first thing, because otherwise they won't make a profit. Okay, secondly, to charge prices that consumers are willing to pay, because even if they are satisfying the first aim, they're producing goods and services that consumers actually want. If they charge too high a price, then nobody's going to buy it. And finally, and this is essentially the main thing, the main important aim, the main goal of firms, as we say in economics. Not always, but with the concept of homo economicus, the perfect rational thinking individual, to organize production so that revenue from sales, the amount of money that a firm receives from selling its stuff that it makes and selling it to you and I, exceeds cost of production. And that essentially means to make a profit. Okay, so they are the three aims of a firm. Well, one absolute cracking way of making a profit, one way to organize production so the revenues from sales exceeds cost of production, is to reduce your costs. Right, well, the first thing we need to think of, and I'm Irish, so there are some references to Irish firms in here, but I'll explain them as we go. You might think that companies like Coke, right, you've heard of Coca-Cola, I assume, Ford Motor Company, or Dunnes Stores, which is like your Walmart or your Target or something like that, would have nothing in common with a local shop, okay? And what we're saying is, actually, as we categorize costs, okay, the categories of costs that they face are exactly the same. Now, the amount of money that each of those massive multinational companies may be paying in terms of cost would be far different to your local corner shop, but still, how we categorize costs are exactly the same. So, well, how do we categorize them? There's loads of different ways and we're going to learn them, but the first simple way is we can split costs up into two separate types or categories, okay? Fixed costs and variable costs. Now, in a second or two, I will explain what these are. But before we start, what I would like you to do is to just pause the video and see if you can reason, and it's okay if you can't, what any of the answers to these questions are. So pause the video now, and once you've had a chance to work through those, press play. Okay, well, hopefully you've had a chance to do that, okay? And what I'm going to do now is essentially answer all of these four. All right, so the definition of fixed costs. Fixed costs are costs that remain the same irrespective of the level of output. If a firm changes how much stuff, how much output it produces, this is not going to cause a change in what are called fixed costs. So let's have a quick example here. If I buy a computer factory, I'll have to get a loan from the bank to provide me with the necessary money to purchase that factory. These loan repayments are a fixed cost, as I have to give the bank a set or fixed amount of money every month. Now, potentially you're studying business management or something like that, and you may intelligently and correctly say, well, hold on a second, John. If the loan is on a variable rate of interest, then if that interest rate rises, well, then that could absolutely cause the repayments to rise, and as such, they aren't fixed. And I would say, well, that is a very fair point, but it's still a fixed cost. And why? It was changes in the interest rate that brought about changes in the fixed cost, not a change in the level of output. So please keep that in mind. It is only changes in output that will cause if they don't cause a change in fixed costs, it's a fixed cost. Okay, so it's if a change in output does not cause a change in the cost, it's a fixed cost. So my loan repayments are 10,000 per month. Whether I produce 1,000,000 computers per month or none, I still have to pay the bank this €10,000. And again, you could say, well, interest rate rise, that could go up to 10,100, and I could say yes, but that change in cost, that change in repayment was not caused by a change in how much stuff my firm is making, and therefore it's a fixed cost. Okay, therefore this loan repayment does not change with the level of output. You see that? The level of output I produce, and as such is an example of a fixed cost. Okay, so let's draw the graph then for a fixed cost. Now, we have costs up here on this axis, and we have the quantity that the firm is making in order to sell to us on this x-axis here. And the fixed cost, or in this case, total fixed cost, excuse me, is just a straight line across. And the reason is because a change in output will not cause a change in our fixed costs. Now, just forgive me, fixed costs are the category. When you add up all the different types of fixed costs, you are left with what are called total fixed costs. And it's exactly the same. The two terms are interchangeable. The IB seems to prefer total fixed costs, so I'll refer to it as that as much as possible. But forgive me when I do refer to it as fixed costs, because right now we're just looking at categorizing these things, okay? So we have our €10,000 loan repayment per month. If I have produced 10 computers a month or 1,000 computers a month, my fixed costs in terms of that, assuming I have no other loan repayments, no other fixed costs, are going to be €10,000. It doesn't matter whether quantity changes from here to here or here to here or somewhere in between. My fixed costs, my total fixed costs, are going to be exactly the same. Now, if you find that a cost does change as a direct result of output changing, it's not a fixed cost, it's what's called a variable cost. So variable costs are costs that do change as output changes. Okay, that's what they are, that's their definition. Okay, and I've got a few examples here. So electricity costs, input costs, and labor. So let's go back to the computer example. If I was producing 1,000 computers per month, and now I want to up that to 2,000 computers per month, or now I have already upped it to 2,000 computers a month, well, what do I have to do? Well, I have to buy more plastic processors, screens, all of that kind of stuff. There's your input costs, okay? Things that are used to make the goods that we produce, okay? There are input costs. They will change, obviously. They will not necessarily double, or could more than double, more on that later, but they certainly will increase if I double my production. Well, I'll have to pay my workers more as they're working longer, and most likely if I'm going to double my production, I'm going to have to increase the amount of workers that I pay. So the wages that they receive, which is different to salary, wages that these workers receive, my wage bill will rise. That's my wage bill. My costs for wages will increase. So therefore, that's a variable cost. And then we also have, I'm going to have to pay bigger ESB, forgive the Irishness here, electricity supply board. I'm going to have to pay bigger electricity bills because my machines will be running in longer and longer and working harder and harder, using up more electricity, and therefore my electricity bill is going to rise, right? So therefore, as output increases or expands, variable costs rise. As an output, and think about this, as output falls, variable cost falls. So what happens if I was producing 1,000 a month and then I go down and I reduce my production to 1,000 per month? Well, I can buy less. That's a reduction in variable cost. I can probably fire workers. Okay, that's a reduction in variable cost. I'll be paying less electricity bills. That's a reduction in variable cost. So as output rises, this rise in output causes variable costs to rise, as output falls, this fall in output causes variable costs to fall. So again, drawing an exact same axes, okay? Costs on the y-axis, quantity on the x. This is quantity that the firm is making, all right, on the x-axis. Now, I have drawn this as upward sloping, as a straight line. Later on, we will add a little bit of a curve here and there to it. Do not worry, it's the exact same principle. So let's think about this. If I was to produce 10 computers, I go up to my total variable cost curve and find out that that costs me €60 in terms of electricity, plastic processors, and wages costs. Okay, now if I start to produce 100 computers, well, I think you will agree that I'm going to need to use more electricity, going to need to buy more plastic and processors, and also going to potentially need to hire more workers. So now my variable cost, my total variable cost, the IB seems to like that, okay, is up at €600. All right, so that's what we're saying. Because cost rose, or because quantity produced rose from 10 to 100, my variable costs also increase. Please keep that in mind. Okay, so we've said that as output changes, variable cost changes. Okay, the one important thing to note is at an output of 0, variable costs are 0. They are here, they're nothing. They change as output changes. So from producing nothing, I don't have to pay my variable costs, but I do have to pay my fixed costs. Don't forget that. Okay, fixed costs are there irrespective of the level of output, even if the level of output is 0. Okay, the next thing, as output rises, variable cost rises, and as output falls, variable cost falls. All of this we have said. Moving from 10 to 100, variable costs increase. Moving from 100 to 10, variable costs decrease. And we can see that here. 10 to 100, variable costs go from 60 to 600. Reducing output from 100 to 10 computers, variable costs fall from 600 to 60. Okay, so these were the questions that I asked you at the start, and I hope now that you can answer these questions. If you can't, that's absolutely fine. Just like I say, rewind the video. I'm so old, but like go back in the video and just watch them again. Take notes as you go and see, what issues that may present themselves, and see if you can solve them through just watching the video. Now, the final thing that we're going to look at in this video, well, the final concept is this idea of total costs. So let's define it, okay? Is the entire cost of production faced by the firm. All total cost is the amount of money, the entire amount of money that a firm has to pay to make its stuff. Okay, that's it. Okay, so if it's McDonald's, it's the entire cost that branch of McDonald's has to pay in order to make burgers, fries, milkshakes, sodas, all that kind of stuff. All right, so that's all it is. It's just you add up all the costs and you get total costs. Now, one way of looking at it, which will prove useful in a second, is total fixed costs plus total variable costs. That's simply it, okay? And let's look at take another look at the graphs here. So what we've got here on the left is our total fixed costs, and what we've got here on the right is our total variable costs. Now, we have just said that to find mathematically total costs, we have to add these two together. So this may become instructive in terms of, well, how do we add graphs? Well, what I'm going to do is I'm going to draw the total fixed cost curve there. I'm going to, the total variable cost curve comes up like this. I'm going to shift it just up to the top. So essentially I'm adding it because there's 0 variable costs and then there's this much fixed cost. So it'll start there and then just go up like that, and we get the total variable cost curve put on top. What we have done now is added graphically the total variable cost curve and the total fixed cost curve. So what I'm now going to do is just get rid of this total fixed cost here and rename this curve simply total costs. That's all it is. So at any level of output, any level of quantity that the firm produces in order to sell to you or me, any level of burgers, I don't know why I'm obviously hungry, I'm sticking with the McDonald's example, any level of burgers and fries and milkshakes and all that kind of stuff that McDonald's sell, right? You can go up to the total cost curve straight across, and that will tell you how much money in total it'll cost them to produce all that stuff. Okay? Now, what I would ask you to do, and I will have to explain a few things, what I will ask you to do is to pause the video. And what I want you to do is calculate fixed costs or total fixed costs, variable costs or total variable costs, and then the total cost of all costs. Now, before we even look at any of these, I would hope you would see that all we have to do to calculate that is simply add all these numbers. But to calculate this and calculate that, we have to separate out each of these costs into, are they fixed or are they variable? Okay. Now I have to make, I have to do two things. Okay. Three things. Rates are an Irish term, and I will give it away. They are a fixed amount that you have to pay to the local council in order to provide a business with water and all that kind of stuff. Okay. So that's rates. Wages, I'm just going to tell you now so that you can understand why. Wages are a variable cost because they change as output changes, but the accountant's salary doesn't. So if you hire an accountant, you say, I hire you to do the books, let's say €100,000 a year for the next 3 years. And let's say, hopefully your company expands in size. You're not paying that accountant any more money. That's part of the contract. So wages are a variable cost and accountant's salary are a fixed cost. Okay, guys, can you do me a favor and can you just pause the video there, see if you can calculate total fixed cost, total variable cost, and total costs. Okay, so I hope you've had a chance to do that. What I'm going to do now is I'm just going to split them up. So we've got our fixed costs. So again, what are we doing? We're separating them out, okay? And then once we've separated them out into what fixed costs are, then we can calculate total fixed costs, okay? So what we're saying here is we have our rent, our rates, our accountant's salary, and our interest. We've already explained why interest is a fixed cost. And what we have as total fixed cost is €148,500. Then what we do is we go on to the variable costs, and what we have are raw materials, we have our electricity, and we have our wages. We add up all of those, and then what we find is our total variable cost is €335,000. Well, we know that our total cost equals total fixed plus total variable cost. So therefore we have to add up these two and we get a total cost of €483,500. Now, I hope that makes sense. I really, really do. And the last thing I'm going to ask you to look at is see if you can answer those questions. And at the end of the video, which is what we are at now, I'd ask you to go through all those questions and make sure you understand it. Most likely you will never be asked this in the IB, but I can promise you one thing. You will not be able to do anything of any greater difficulty, which you will be asked, if you don't understand these basic terms.